Welcome to podcast episode 22, where to look for funding opportunities during a pandemic.
Welcome to the PR Playbook podcast with Ranjini Joshua, the only podcast that teaches you how to strategically navigate the world of public relations and social media and grow a powerful brand.
Hi there. Today's episode is a little bit different than most of our episodes that are more focused on applicable PR tips and how to shape your communication strategy. But in order to have a good communication strategy, you need to set up your framework. And a lot of you all in the audience are startups. So without funding, you can't set up a communication strategy. So hopefully we can help you put all the pieces together in this really volatile market. There's so many questions about the future of startups in 2020 and where to get funding and how to get funding. So I thought it might be important to have a conversation on a funding financial markets expert. Today I have Ted Parker. Ted is the Senior Vice President of Millennium Trust Company, the leading custodian of alternative investments. So today we are going to talk about everything from peer-to-peer lending to private equity, to see what opportunities that you might be able to take advantage of in 2020. Ted, thank you for being here.
Ranjini, well, thank you very much for inviting me. It's a pleasure to be here.
Great. So I'm so excited. This is a little bit of a different content style, but I think it's very useful. A lot of people have been asking me about crowdfunding. A lot of people have been asking me about regular funding, and we do quite a bit support startups that are hoping to nurture their investor relationship. So I think this is a really applicable call right now, especially since people are not quite sure what to do with funding if they haven't received it already. So I hope you can shed some light on it for us.
Absolutely. I'm happy to be here. And a little bit about my background. I've been in the capital markets. Been in the capital markets for, I'm embarrassed to say, almost 3 decades, working for companies like Fidelity Investments and Charles Schwab Corporation. And I was recruited by Millennium Trust to help cover the West Coast, helping people with these alternative investments, including private companies like your audience.
Mm-hmm. Great. So I think, I think you have a lot of information. We talked, a little bit in our pre-call about new opportunities for startups or opportunities, not just new, but things that they maybe have not thought of before. There are a lot of, questions about investments right now because the market is so volatile and nobody's really sure what to think. I think a good place to start this interview is maybe just kind of give us a broad kind of overview or perspective of what it looks like in the market right now and what's going on in investing in general so that we can kind of hone in on some questions moving forward.
Absolutely. And I'll focus on the startup community because that is the one place that institutional investors, when I talk about institutional investors, I'm talking about the big players in the markets. That would be like Harvard's foundation. On the West Coast, you've got USC, Stanford. They all have enormous foundation accounts, and they create model portfolios to manage the risk and the return. And you might be kind of surprised, and your audience might be kind of surprised on how much these institutional investors allocate to alternative investments in general. Okay. And by alternative investments, I'm talking about those investments that are not traded on the market exchanges, not on the NASDAQ, the S&P, the Dow, the Russell, any of those things. They're not traded on those platforms.
Sure.
So the typical average investor, this would be your neighbors, yourself possibly, and your friends and your family, typically has 66% of their portfolio in equities, stocks, 16% in fixed income or bonds, and then 18% in cash. That's a typical allocation for the average investor. The average university or endowment plan has 53% in alternative investments.
Oh, wow. Yeah, that's impressive.
and they're not buying an ETF to satisfy that alternative space. They're buying, for example, real estate is the largest single holding. Typically, it's about 30% of the overall portfolio. The second largest allocation is to private company stock, which startups are in that category.
Sure, yeah.
And that category is typically about 16% of the allocation. And more of these endowments are looking to increase their allocation to these startup and private company stocks because they look at that as giving the alpha performance of the portfolio.
Is that unique to what's happening right now, or is this pretty general, pretty common?
Mm-hmm. Well, the percentages I quoted that's what it's been in past historic, and what they're doing, they're increasing the exposure to the private company stock.
Okay.
Because it used to be that companies would come to markets quickly. You look at Microsoft and Amazon and Google, all those companies, they started out as private companies in someone's garage, and very quickly they went public. Mm-hmm. So most of the performance that investors got was when they were public.
Right.
Well, for whatever reason, companies are waiting longer to go public, private companies. Mm-hmm. And part of the reason for that, I think, is they don't want the public scrutiny of what they're doing. A lot of startups are founded by entrepreneurs, obviously.
Yeah.
And they typically have large egos. They don't want people telling them what to do. But that asset class, private company stock, is what gives the extra alpha. And alpha is the extra return above market.
Okay.
So it's more and more opportunity for these startups. If they've got something that's unique and they've got a consistent track record of earnings, who knows, maybe USC would make an investment in them as part of their endowment.
So you actually just mentioned a track record of earnings. Does this mean that they have to be revenue positive already to be considered for some of these?
Absolutely not. No. In fact, most startups don't generate revenue until some number of years later.
Sure, of course. Which I think at that point they're not a startup, but yeah.
Right. And what these entrepreneurs have for extra funding, they typically go to friends and family.
Yeah.
But friends and family often can't give them the amount they need to take them to the next level.
Sure.
To buy the extra technology, marketing, whatever it is. Typically, friends and family get tapped out. They're happy to help, but they get tapped out.
And where do you see the second level usually coming in? I'm thinking just off top of my head is around like anywhere upwards of 150 to 200 to upwards of that. Is that what you're thinking, like kind of as far as numbers go?
Yeah, well, as far as the amount of investment, that's it's hard to say because the two ways of funding that typically pursued by startup companies, one way is venture capital, which I can explain what that is.
Yeah, that'll be good just in case people don't know, but I feel like we all know, but a quick explanation is always good.
I won't spend a lot of time. Venture capitalists, they'll often invest in private companies with the idea that they want a number of board members on your board. They want a controlling interest, 50% or more.
Right.
And they are not afraid to tell you what you're doing wrong and what you need to do to get to the next level. They only make these investments if they think they can get a multiple of their investment out within 4 to 5 years.
Sure.
When I say multiple, it's 3, 4, 5 times the amount they invested in that short period of time. A lot of startups don't like venture capital route because they have to give up too much of their control, too much of the ownership, and they've got uninterested board members on their board telling them what to do. Quarterly meetings, and it's a lot of startups don't like to go that route.
Sure.
So the other route is through crowdfunding. Mm-hmm. And because of the Jobs Act that President Obama signed into law, that allows accredited investors, people like you and me, to be able to invest in our friends' startup companies. And you can compare that to venture capital. Venture capital is actively involved in the companies they buy, whereas crowdfunding, they're all passive investors. So for whatever reason, the investor likes that company's story, and they think it's going to be the next Google or the next Amazon or whatever it might be, the next of. So they're willing to take a risk and invest some money with them to buy a certain number of shares, but they're not going to tell that entrepreneur how to spend their money, how to grow the company. They're passive investors, very much like you would be if you bought a stock or an ETF on the market.
Right. Yeah. I mean, we've seen the whole regulation A plus crowdfunding investment, it kind of grow over the past four or so years, I would say, one from interest. And then finally, when the law passed, we're seeing a lot of platforms like Fundable and Start Engine really supporting these startups that are looking for passive investors like you're talking about.
Correct. Absolutely. Okay, did you have any other questions about that, or are those the two routes, the venture capital
Yeah.
and crowdfunding?
Yeah. So I like to talk a little bit more about alternative investments. And what are some creative ways that maybe startups and other growth companies could be potentially looking for investors or investments to get to their stage? So you talked a little bit about the endowment funds, but I'm sure there's a whole category, this whole alternative category that opens up quite a broad spectrum of potential investors. What could startups be looking for when they're looking for this type of alternative investment, or what are the opportunities there, I guess?
How do you find the money?
Yeah, basically.
Yep, that's the biggest challenge. Globally, there are different associations that provide a meeting place for angel investors and just wealthy investors in general that are looking to invest in startup companies. So that would be one way. Get yourself involved in one of those groups that does that. For example, there's a company called Kiritsu, and I really should look up what that word means. It's a Japanese word for something, but it must be something good.
Yes, hopefully.
But they've got offices all over the world, and they've got even a branch in San Diego, and kind of near where you're at. Mm-hmm. What they do is they hold, it seems like almost weekly meetings for investors who like to invest in startups.
Okay.
So what happens is the startup founder would go to the meeting in San Diego, for example, and they would have 15 minutes to explain who they were and why they started this company and the benefits and the risks with it. And the audience is then available to ask questions. And that's a good way to get your name out and to get some investors.
Kind of like a speed pitching event type thing.
Exactly.
Okay.
Yeah. Mm-hmm. And then most people who invest in startups, unless they're super wealthy, mm-hmm. they prefer to invest in them through the vehicle of a fund. Okay. So that would be another route. If you can find somebody who's putting together a fund of startup companies. In fact, maybe that may be something that one of your listeners wants to do, is create a fund where they, if they've been in space for a while, they can get investors to invest in, because the benefit of a fund is you're diversifying your risk. The startup community or private stock community, you can think of the performance metric of that as being like the shape of a hockey stick.
Sure.
So for a number of years, it might be 2, 3, 4, 5 years, it does nothing. There's no real performance or something. And then something happens. Let's say that startup company gets bought by a bigger competitor. Then the share price goes way up. So you can imagine the hockey stick example.
Right, right.
Another thing that could happen is they have such a brilliant idea that they get more and more investors, and they decide to go public themselves.
Right.
So those are two things that could possibly happen. Okay. But more often than not, you only need to own one or two of these startups to get that extra alpha. Mm-hmm. Because a lot of them will do nothing for a long time, and the founders may get frustrated and go back to their day job.
Right.
So that's the risk. The risk is that the investment goes nowhere, and if you put all your eggs in one basket, you follow me?
Yeah, no, absolutely. I mean, so a lot of the startups that we work with, or that I've met, I mean, these startup founders are passionate. They're probably not going back to a day job. Like, they've put their own, like, they've gotten their friends and family investment. They've put their life savings into it. So if they're from that perspective, on the other side, on the startup side, if you've got everything into this and you're looking for these investors and you're looking for money, finding the money, what is the best way to position yourself? Because
Sure.
I think a lot of these guys, they do go all in,
Yep. Well, a good way is to get your company stock registered with a company like Millennium Trust. And what that means is that we would, the startup would contact me or one of my counterparts who covers the rest of the country, and we would collect their planned documents. Planned documents essentially are the investor agreements.
Sure. Okay.
The private placement memorandum, any type of investor agreement that investors would have to sign to be able to invest their money with this company. And if you come across an investor that wants to use their retirement account money to invest in your private company, you're required by law to use a custodian, like Millennium Trust. So we specialize in the alternative space. We have over $27 billion of assets that we custody, and most of them are alternative assets.
Okay.
And this is a mind-boggling number, 21,575 unique alternative investments that we custody.
Oh, wow. Yeah. That's pretty big. Do you guys have some kind of the first thing that comes to mind if I was a startup is, do you have some kind of checklist of things that we would need to submit to you or anything like that, just to make it easy, just to kind of go down the list and make sure we have everything?
Absolutely. And it's real simple.
Okay.
If you want, after the call, I can send you an email with the list of documents we collect.
Yeah, we could put them in the show notes. I think that'll be perfect. And then people can use it as a resource if they want to contact you, and that we'll have that checklist for them.
Right. Yeah. So basically it's just a private placement memorandum and any of the documents the investor would need to sign.
Okay.
And we've got a whole team in Oak Brook, Illinois, where our headquarters is, that they review the planned documents. And what they're looking for is our ability to act as a custodian. They place no judgment of good business sense to invest in the stock. It's just to make sure that we can do what we need to do.
Sure.
And we've seen planned documents that have what we call the Madoff clause. Do you remember Madoff?
Yes, of course.
Yep. He robbed a lot of people of a lot of the money they had, and is still sitting in prison for doing that. So we've seen planned documents where, for example, typically they're lengthy documents, might be 30, 40, 80 pages.
Okay.
It could be one sentence that says the custodian is liable for any actions of the investment sponsor. So what that meant was that if you invested whatever amount, $500,000 in that company, in that private company, that person who was running that company could actually take your $500,000, and Millennium Trust would be liable for getting that back for you. So that's all. We're making sure there's no Madoff clauses,
right?
And that the investor isn't being promised some outlandish performance returns. Okay. So it takes, once we have the documents, we have a secure portal where they can upload those documents into. We give them a ticker symbol, and then they can if they want, they can advertise that if people want to invest their IRA money or their Roth money or their pension plan or whatever type of qualified account, those dollars, they can do that at Millennium Trust. And the startup, the startup company doesn't pay us any fee for that.
Okay.
The only fee that we charge is we charge investors an annual custodial fee for that one account.
Right. I mean, that's pretty common, isn't it?
Yeah, it is. But one of the things about us, we are the preferred custodian for firms like Charles Schwab and Fidelity. They won't typically hold these private stocks. So if you wanted to put them in your retirement account at Fidelity, you couldn't do it. Same thing with Schwab. Typically, they don't want that because of the risk, and they don't know how it's reported and whatever. That's why these companies have to use us. And so they can tell their investors, if you want to invest your IRA money, click on this link. It takes them right into Millennium Trust with their ticker symbol marked in there.
Okay, great.
They provide all their information, and then we take the money from their Fidelity account or the Schwab account over to Millennium Trust. And then we contact the startup company and say, here's $250,000 that just came in from Ted Parker's rollover IRA. We're going to wire it into your bank.
Wow. And is there some kind of setting like they're now looking for investments, they're not looking for investments? Do they have like some kind of profile to set up?
With us?
Yeah.
No, we just need to collect their plan documents. And as a
Okay.
custodian, we can't, sorry, but we can't market any of the investments, any of the 21,000 assets we custody. We can't market those to people.
Okay.
But a lot of people don't know they can use their IRA money to invest in private companies.
Okay.
And I bet if most of your startups went back to their friends and family and said, I know, Mr. Doctor, you've got a big pension plan. Do you want to invest some of that money through your pension plan?
Yeah, I might open up some additional funds there. Yeah, absolutely.
Yeah, exactly.
Well, I mean, this is awesome. I think this is definitely an alternative that people may not think of, or may not it's like a hidden funds that people don't know that they can tap into, both the investor and the startup. What are kind of maybe a couple of the biggest mistakes that you've seen in this process that people can avoid so that they can, really optimize these opportunities?
Good question. Well, one of them is advertising. Unfortunately, you can't advertise these investments, or you'll get in trouble. So basically, talk to the law firm that prepared your plan documents and ask them, what can you do to promote the investment?
Okay.
And that'd be the first thing, because if you were to make an advertisement of some form and somebody invested in it, you could end up being fined, and you could a lot of legal time to unwind that.
And I just percolated on this question for a little bit, but we were talking about crowdsourcing, crowdfunding, and platforms like Start Engine and Fundable, where they could do the Regulation A+. So if you wanted to use your, let's say, Roth IRA for funding in a startup through a platform like Start Engine or something like that, like a crowdfunding platform, can you do that too?
Absolutely. Yeah.
Okay.
And then that platform can advertise. That platform can put out mass email to all their followers about why they
think you're a good pick or something like that.
Exactly. Yeah, but you'll still need, if you want to use your retirement money, you'll need a custodian. That's where we can step in and help on that.
Okay. Got it. Okay, cool. That's really, really interesting. It's really good to know, I think. What do you think these startups should just know before? I mean, obviously this is passive investing, so you're not going to get a bunch of overlords on over your company, but I know there's probably some best practices just to maintain relationships and obviously to report. And I know there's some requirements on that, but are there a few best practices that these startups should be considering when taking these particular types of investments, and how they should manage these investors?
Sure, absolutely. One of the things to consider is some of these platforms have low minimums. There's one platform up in the Bay Area that investors can invest as little as $500 in these startups. Okay. So I think you need to set your, especially if you want to go after the larger money, the angel investor money, or some corporate money. Mm-hmm. You should have a higher minimum of the investment, and then you'll get people that are serious about it, and they won't be sending you an occasional email saying, "I haven't heard anything. What's going on with my investment?"
Right.
So that's one of the things, is to, expect that you're going to have people want to invest smaller amounts, but set a minimum that you feel you're comfortable with.
Right. Yeah, I think I've seen, amounts as low as like $100 or $10. I mean, what are some of the troubles that you can get into when you have something a little bit lower like that?
Well, your accounting expenses are going to go up.
Right.
Because you have to prepare
more people. Yeah.
Yeah, you have to make all the reports go out, and you have more likelihood of a disgruntled investor calling you and, why isn't the stock moving? The market's up today 500 points. Why isn't my private company stock up today?
I think a lot of these startups, they, I've worked with a few startups that want to be able to get everybody involved. Like, hey, we want to include everybody for the sake of inclusivity, they'll do lower stock amounts, which I think it's really good to know what the pitfalls of that is.
Definitely.
Yeah. So if there's, other than prep work or paying for administrative fees, anything else that you think that is just really noteworthy to be able to take away from that?
Well, you're going to want to go eventually, if you're successful, and the crowdsourcing gives you a certain number of dollars to be able to take it to the next level. You may want to go the venture capital route, because venture capitalists, in addition to buying part of your company, they open up their checkbook and they help you buy things that you need. So if you have a bunch of investors that are $100 investors, they won't be as impressed as if you had, maybe several at $100,000 or $250,000 or $50,000.
Right, absolutely. And what is the can you remind us what the max is when you're looking at crowdsourcing from investments like these?
The max investment amount?
Yeah, from like, let's say from someone investing from their Roth IRA, is there a max?
No, there really isn't. I mean,
Okay.
You'll find some people that they really love your company. They could put their entire retirement account with you. In fact, I know people have done that, especially with real estate crowdfunding.
Yeah.
I know people who put their entire retirement account money with one real estate investment, which is kind of risky.
Yeah.
But yeah.
But it happens. Well, I think this is really something for people to think about. I definitely always encourage people to do their research and maybe even, maybe connect with you. And in the show notes, we will have your contact information on how you can get a hold of Ted and talk through some of this with him if you have questions.
Absolutely.
Because I think, having options when you're looking for funding, it can be a relief for a lot of people. So
absolutely. They can focus on what they really needed to do as opposed to the fundraising, but so many of them spend more of their time with fundraising.
Absolutely. Yeah. Well, I think you've given us a great box of tools today. Again, we'll have the checklist and we'll have Ted's information in the show notes. I would love for the audience to be able to connect with you. Is there anywhere in particular that you respond better, or someplace they can find you quickly?
Sure. Well, let me point out that Millennium Trust Company has a lot of good information for startup companies and for investors who want to invest in startup companies.
Great.
We've got we believe the biggest challenges that investors have on finding alternative investments is where to find them, how to understand what they are, and then how to invest in them. So I would suggest that they go to our website, which is mtrustcompany.com, and they can download the ebook there that I referenced some numbers from. There's an investor ebook that talks about the differences of endowments versus individual investors.
Great.
And it kind of explains the whole benefit of owning these alternatives. But I think your audience is in probably the best space during this pandemic because, like I said, these endowments are putting more money in private company stock because they get extra returns there. Anybody who's been in the market this year has seen huge swings, daily swings in the market. And again, these private things, they don't perform like that. So
right.
I'd encourage them to go to our website. Please provide my email address in your communication. And if anybody wants to get their private stock approved for use in retirement accounts, contact me and we'll get that set up.
Great. Thank you so much. I really appreciate your time today. It was great having you. Great talking to you.
Thank you, Ranjini. It was my pleasure.
Yeah. So as always, if you guys have questions, like I said, head over to the show notes for all the details on Ted Parker. And if you have questions, comments, or suggestions for podcast topics, please email us at podcast@thesilvertelegram.com or visit our website at www.thesilvertelegram.com. Thank you for listening. Until next time, have a great day, stay positive, and aim high. Thank you.